Good morning. I hope you're doing well. In today's video, I would like to talk about the taxes as applicable to traders. The reason for this video is because of one of the comments that I received in my earlier videos from I think a user by the name Mojo Rojo, who requested that I create a video which informs about the taxation as applicable, and I felt that this information might be useful to those who are watching it. So when it comes to taxes on trading, we have basically four income groups. Now the four income groups I have put it in column A. You can see the four rows. That is long-term capital gain through equity, short-term capital gain through equity, F&O trading as business income, and F&O trading as speculative income. So you will have these four income groups in your tax slab, in your ITR. Now, long-term and short-term capital gains are only applicable for non-leveraged trading. That is where you take full delivery. That is in equity, where long-term capital gain is applicable only if the holding period is greater than 12 months. For any transaction in which the holding period is less than 12 months, be it equity or mutual funds, it will be considered as short-term capital gain, and the tax rate is the base rate is kept at 20%. So we have these four clusters, and you can see that there are, broadly speaking, there are three base rates or three tax rates that are applicable. Now essentially we can see that F&O trading as business and F&O trading as speculative income both have similar tax treatment, but they are under separate heads. F&O trading for speculative income refers only to your day trading activities, whereas that of business income refers to positional trading. For the purpose of squaring off, which means let's assume in a particular financial year you have had a loss of 1 lakh rupee in your day trading, and next year you gain, let's say, 10 lakh rupee. If that 10 lakh rupee can only square off the loss from day trading or speculative trading if it has been if you have earned it through the process of day trading itself, at least 1 lakh rupee of it needs to come from there. So in other words, these two are considered to be as two separate slabs, and they are reported separately, and therefore not all losses can be squared off, but losses within the same slab only can be squared off. Okay. So now what I have done is, obviously there are these incremental slabs in our taxation. You have zero taxes for an income of up to a certain level, and then it just gradually increases. What I have done is I have simply assumed that your income for the year through either one or all of these activities is, let's say, 10 crore rupees. So clearly all sorts of surcharges and cesses are applicable for you, so that we can discuss those topics. So here you will see that the base rate is 12.5%. Obviously 1.25 lakh is exempt, and it is above that you pay 12.5%, but we will note that 1.25 lakh is a very, very small fraction of 10 crore rupee that we have assumed as the earning in this case. So the base tax will obviously be 1.25 crore, and for equity STCG it will be 2 crore. For F&O trading as business and speculative income it will be 3 crore. Now the surcharge is capped at 15% for any trading regarding equity and mutual funds, right? So on this base of 1.25, we will have a 15% surcharge on it, which means an additional 0.1875 crore will be levied on the person. Similarly, for equity STCG, also a 15% surcharge will be applied on the base of 2 crore rupees to give you 0.3 crore or 30 lakh rupees as an additional surcharge. For F&O trading, regardless of whether it is business or speculative, we have a 37% surcharge, which is quite huge, and sorry, so you will have to pay an additional 1.11 crore as surcharge tax. Then after surcharge we have a cess, and the cess is 4% of whatever is accrued, that is on the base and surcharge. So the cess is on basically health and I think infrastructure or education and things like that. So the cess will be 4% on whatever is the base plus surcharge. So 4% of, in this case, 1.25 plus 0.875 is 0.0575, which is say approximately 5 lakh rupee, 5,75,000 rupees cess will be applicable for income earned through long-term capital gain in equity of approximately 10 crore. The same calculation has been worked here, where this will be at 9.2 lakh rupee for STCG and 16.4 lakh rupee for FNO trading, be it business income or speculative. With this, we get our total tax on an income of 10 crore rupee, which is 1.495 crore in case of LTCG, 2.392 crore in case of equity, and 4.274 crore in case of FNO trading, which means that the effective tax rate is 14.95% in equity, and it goes up to 42.74% when it comes to FNO. So you're going to give away a lot of your income as gains and as taxes, and let us just see what we can take away from this here. So first of all, there is this impartial treatment or unfair treatment, because you will see that FNO trading as business income has a base slab of 30%, whereas the industry standard is 25%, which was changed when if you remember, Nirmala Sitharaman made that announcement where all corporate taxes were cut to 25% business taxes, but for FNO that cut was not applicable, giving it a very step child treatment actually. So logically, when you are paying such high bases, the need of the hour is to get adequately funded so that you can shift into trading equities. Because adequately funded, why? Because a trader is trading the market to generate income, and to generate income through which you can lead your life satisfactorily by trading equities, you need a very large capital base. And once you have a very large capital base, the responsibility becomes to be a very sound risk manager. So therefore, the purpose of your short-term FNO trading today is to be able to generate a capital base which will allow you to take up positional trades in equity in the future. And the purpose of short-term FNO trading today is to teach you how to manage risk, because you are going to be doing that on much larger capital base in the future. So so if you freeze in the event you see a loss of 50,000 rupee, 1 lakh rupee, etc., and you're unable to exit the trade, or you behave poorly in the event of seeing a very big loss or a very big gain, then obviously it's a sign for improvement, and that you're not really ready to take it up to a level. Because we can see that your trading behavior and your market actions have to be aligned with the taxation if in case you really want to become like ultra wealthy in the future. Obviously traders pay close to 42% of our net profit as taxes, compared to 15% for equities, which means that if I'm holding a futures position for 3 months, if I just make it 12 months, I save incredible amounts of money, and this amount of money runs into crores a year if I simply make that shift. When you are earning maybe a few lakh a year, you are almost exempted in various slabs, and therefore you're not really paying that much as tax, and it doesn't affect that much. But once your scale increases, at that point in time you realize that there are certain decisions you have to take in accordance with the tax slabs, because when things get rough for you, all this extra payment that you have made really comes back to hurt you. Now, this differential of 42% and 15%, you must understand that in the financial market, differences are generally considered in basis points, which means 0 point some percent. But if there is a differential of almost 27%, then it is unprecedented, and it is a strong enough reason for anyone to consider changing their trading process. And in this, therefore, I want to answer the question when very often people ask me what is my view on ultra short-term trading, then my view is just this, that we are paying a lot. And the purpose of trading is to make you a fantastic risk manager so that you can get adequately funded to trade equities and lead a reasonable, comfortable life. But if you are only trading for calculating percentage gains without evaluating how you are managing your risk, then you might acquire the percentage gains on small capital, which means you invest 1 lakh and make 1 lakh. But the minute you gain that confidence that you made 100% returns and you put in 20 lakh in the market, your inability to manage risk is going to put that entire 20 lakh in a lot of risk. So use FNO trading as a sparring partner for risk management, and then when you have say maybe 5, 7, 10 years of this experience, When you come into equity trading, I means you will just simply be head and shoulders above the average equity investor. I mean, it's not even comparable how much you're going to dominate them, because your behavior is just going to be top notch. The next point that I want to make is that you are going to pay a lot in your taxes. Make sure that you invest in small schemes, the government schemes. Make sure you do that. Don't be a fool. Just remember, all financial planning, trading advice, everything comes into play only when you are rich. If you are poor, there is only one advice for you, and that is you need to work hard at the job you're doing currently, so that you create stability of income, square off any liability, then use that stability to propel you further to create additional income sources. And your first additional income source should be usually via rental income. Once you have a couple of income sources like that, it is then, and no liability, it is only then that you actually come in the market. So you will obviously make savings. Not every saving has to be in crores, but if you are making a saving of anywhere amount between 500 rupees to 1.5 lakh rupee, investing into PPF for yourself is mandatory. Now, if you invest 500 rupee into PPF, I suggest you invest 500 rupee into National Pension Scheme also, because PPF is purely debt linked. It is amazing, the product is great, and National Pension Scheme is the cheapest mutual fund in the world at 0.04% expense ratio, compared to an average mutual fund expense ratio of almost 1%. See, a mutual fund is going to return 12% on an average. That's what they claim. I don't know, but they say it'll return 12%. We already know that 15% of that has to go as a tax, which means 1/8 of it is going away, which means 1.5% of those 12% are gone. So effectively, that leaves us with 10.5%. And on that 10.5%, if you're paying an expense ratio on an average of 1%, you're essentially left with 9.5%. This is if the mutual funds do what they claim to do of giving 12%. So 12% of mutual fund is realized at 9% for you in the long term. Now, obviously, if you are going with the NPS, this 9% automatically goes and jumps to 10%. That's a huge amount on that kind of a base, because you would have invested for 30 years. And you will see those returns are very close to PPF and Sukanya Samriddhi. So these are absolutely mandatory investments. You must do it. You must do it for yourself, and you must do it for your family. And it goes without saying, getting an health insurance is absolutely mandatory. Given that a PPF has a cap of 1.5 lakh rupee, and you would want to make a ratio of 1:1, so you will have 3 lakh rupee in terms of PPF and NPS. And then you will have some health insurance. Let's just give it a fractional amount, 5 or 10 or 15,000 rupees. So for every individual to get fully invested into small government schemes, they need to make a saving of approximately 3.5 lakh rupee per year on an individual level, which accounts to roughly 30,000 rupees per month, which is huge compared to the average that is there in the country. Now, let's assume you save 30,000 rupees per month. You know what you have to do: 1.5 lakh in PPF, 1.5 lakh in NPS, and the remaining difference goes into health insurance for yourself in a family floater kind of a product. But let's assume you save more than 30,000. Let's assume you save 60,000 rupees. Then you know the same 1.5 lakh in PPF and 1.5 lakh in NPS has to go for your wife. Then you save another 30,000. Then that has to go for your son or daughter. In case of son, the product will be the same, PPF and NPS. The only difference will be that in case of daughter, instead of the PPF, you can do a Sukanya Samriddhi and NPS. Because we want to create a family corpus in which money is assigned to debt and money is assigned to equity linked product, and a cheap equity linked product, low cost equity linked product, which is managed and overseen by the government, and which creates a very stable base for you beyond 60, because not everyone is currently at a level, financially speaking, to take risks and then pay 42% of it. I mean, if you eventually do succeed, if you really do make, you will feel, I just made 10 crore rupee, but actually you just paid 4 crore 20 lakh to the government. And when you're left with 5 crore 80 lakh rupee, you'll realize there are all sorts of problems with it. Lastly, I'll just make the disclaimer that I am not a CA. CAs are subject matter experts on this topic. I am not one. I speak from the perspective of traders. The presentation only aims to serve as a practical guide. There is a big difference between tax avoidance and tax evasion. Tax avoidance can be done through legal planning, which is what I mentioned through PPF Sukanya Samriddhi. Tax evasion is done through illegal reporting, and I obviously do not endorse that, and I guarantee you shouldn't do that, because you will get caught when you do something big in your life. So if you have losses, also do report them in ITR2, or just consult your CA, they will advise you. We have learned that LTCG, STCG, business and speculative income are the brackets. Traders and investors are in different brackets. Traders rely on the markets for income, and investors allocate their savings to the market. We can only claim minor expenses through this activity, such as advisory, internet, and depreciation. And in case of advisory, I encourage you to submit the TDS for the service provider so that you can claim the tax benefit. I hope that this video has been useful. I hope that this slab is useful for you in planning, and I hope you understand why the general recommendation is to shift your trading from FNO to equity over the longer term. I wish you all the best, and thank you for your time.